Startup investing can be both exhilarating and daunting. The potential for massive returns is real, but so are the risks. Understanding the dynamics of this high-stakes arena is crucial for anyone looking to dive into the world of startups. Why startups attract investors? Potential for high returns. Startups offer the possibility of exponential growth, which can translate into significant returns on investment. Early investors in successful companies often see their stakes grow many times over. Innovation and disruption. Startups are typically at the forefront of innovation, challenging established industries with new ideas and technologies. Investing in them allows you to be part of groundbreaking advancements. Portfolio diversification. For seasoned investors, startups provide an opportunity to diversify their portfolios. This diversification can help balance the risks associated with more traditional investments. The risks involve high failure rate. The reality is that many startups fail. Studies suggest that around 90% of startups don't make it past their early stages, which means that the majority of startup investments can result in losses. Liquidity issues. Unlike publicly traded stocks, startup investments are illiquid. It can take years before a startup either goes public or gets acquired, providing an opportunity to cash out. Market volatility. Startups are often subject to extreme market volatility. Economic downturns, changes in consumer behavior, or competitive pressures can dramatically impact a startup's chances of success. Key considerations before investing: due diligence. Thoroughly research the startup's business model, leadership team, market potential, and competition. Understanding these elements can help you gauge the viability of the investment. Investment size. Only invest money you can afford to lose. Given the high-risk nature of startups, it's wise to allocate only a small portion of your investment portfolio to these ventures. Exit strategy. Consider the potential exit strategies before investing. Whether through an IPO, acquisition, or secondary sale, understanding how you might eventually cash out is essential. Spotting a promising startup. Identifying a startup with high potential can be the difference between a lucrative investment and a financial setback. Here's how to evaluate startups effectively to increase your chances of success. Strong leadership. Experienced founders. Look for founders with a proven track record or deep industry knowledge. Successful startup leaders often have a history of overcoming challenges and driving growth in their ventures. Vision and execution. A great idea is only as good as the team executing it. Assess whether the founders have a clear, actionable vision and the ability to turn that vision into reality. Their passion, commitment, and resilience are key indicators of their potential to lead the startup to success. Market potential. Addressable market size. The startup should be targeting a large and growing market. A bigger market provides more opportunities for growth and reduces the impact of competition. Customer need. Understand the problem the startup is solving. Is there a genuine demand for their product or service? Startups that address critical pain points or unmet needs have a better chance of gaining traction. Scalability. Evaluate whether the startup's business model is scalable. Startups with scalable models can expand rapidly with minimal increases in cost, allowing them to grow efficiently and maximize returns. Competitive advantage. Unique selling proposition, USP. The startup should have a distinct advantage that sets it apart from competitors. This could be a unique product feature, a patented technology, or a business model innovation. Barriers to entry. Consider the barriers that protect the startup from competitors. These could include intellectual property, customer loyalty, or a strong brand. High barriers to entry make it harder for others to replicate the startup's success. Industry connections. Startups with strong industry connections or partnerships often have a competitive edge. These relationships can provide access to resources, networks, and market opportunities that accelerate growth. Evaluating financial health and funding. Understanding a startup's financial health and funding status is crucial when considering an investment. Financial stability, coupled with a smart funding strategy, can provide the runway a startup needs to achieve its growth potential. Current financials. Burn rate. The burn rate indicates how quickly a startup is spending its cash reserves. A high burn rate might signal aggressive growth, but it can also indicate poor financial management. Ensure that the startup has a sustainable burn rate relative to its funding. Runway. Runway refers to the amount of time a startup can operate before it runs out of cash. A longer runway provides the startup with more time to reach key milestones without needing additional funding. A short runway, on the other hand, can increase the risk of failure if the startup doesn't secure new funds quickly. Revenue streams. Evaluate the startup's current and potential revenue streams. Are they diversified, recurring, and scalable? Startups that rely on a single revenue source are more vulnerable to market changes, so diversified income streams are a positive sign. Funding history. Previous rounds. Examine the startup's funding history, including previous investment rounds. Look at who has invested in the startup and how much was raised. Support from reputable investors can be a good indicator of the startup's potential, as these investors often conduct thorough due diligence. Valuation trends. Analyze the trends in the startup's valuation over time. A steadily increasing valuation suggests that the company is making progress and achieving its milestones. However, an inflated valuation without substantial growth can be a red flag. Cap table. The capitalization table, or cap table, details the ownership structure of the startup. It's essential to understand how much equity has been allocated to founders, employees, and investors. A balanced cap table ensures that key stakeholders are incentivized to drive the company's success. Future funding needs. Funding strategy. Assess the startup's future funding needs and strategy. Will they require additional rounds of funding to reach profitability or significant growth milestones? Consider how dilution might affect your investment if new funding rounds are required. Investor alignment. Ensure that the startup's goals align with those of its investors. Misalignment can lead to conflicts and strategic missteps that jeopardize the startup's success. Assessing the startup's product and market fit. One of the most critical aspects of startup investing is evaluating whether the company's product truly fits the market it's targeting. A strong product market fit is often the difference between a startup's success and failure. Understanding the product innovation and differentiation. The startup's product should offer something new or significantly better than what's currently available. This could be through innovative technology, better usability, or a more effective solution to an existing problem. The product's unique value proposition should be clear and compelling. Development stage. Determine where the product is in its development cycle. Is it still in the prototype phase, or has it been fully launched? A product that's already generating revenue is generally a safer bet than one still in development. However, early-stage products with high potential can offer greater upside if they succeed. User feedback and adoption. Look at how customers are reacting to the product. Positive user feedback and growing adoption rates are strong indicators of product market fit. If possible, review customer testimonials, case studies, or any available data on customer retention and satisfaction. Market fit target audience, clearly identify the startup's target audience. The product should meet the needs of a well-defined customer segment. A deep understanding of this audience's pain points and desires is crucial for the startup's marketing and sales strategies. Market validation. Market validation involves confirming that there is a real demand for the product. This could be demonstrated through pre-orders, a growing customer base, or successful pilot programs. The more validated the market, the lower the risk for investors. Scalability in the market. Evaluate whether the startup's product can scale within its market. A product might work well on a small scale, but scaling it up could present challenges. Consider whether the market is large enough to support significant growth and if the startup has the capacity to meet increased demand. Competitive landscape. Market positioning. Assess how the startup positions its product in the market. Is it seen as a premium offering, or does it compete on price? Understanding the startup's positioning helps you gauge its potential to attract and retain customers in a competitive landscape. Barriers to entry for competitors. Determine what barriers exist that would prevent competitors from easily replicating the startup's product. This could include proprietary technology, regulatory approvals, or high initial costs. Strong barriers to entry can protect the startup's market position and enhance its long-term prospects. Industry trends. Consider broader industry trends that could impact the startup's product and market. Is the industry growing or shrinking? Are there upcoming technological advancements or regulatory changes that could affect the market dynamics? Being aware of these trends helps you make a more informed investment decision. Evaluating the startup's growth potential and exit strategy. Investing in startups is not just about identifying a good business idea, it's also about understanding how that idea can grow and how you, as an investor, can eventually realize returns on your investment. Evaluating the growth potential and exit strategy of a startup is essential to making informed decisions. Growth potential. Revenue growth trajectory. Look at the startup's current revenue growth and projections for the future. A strong upward trajectory is a positive indicator, but it's crucial to analyze what's driving that growth. Is it sustainable? Are they acquiring customers at a reasonable cost? High growth with unsustainable expenses can lead to trouble down the line. Market expansion plans. Assess the startup's plans to expand its market reach. This could involve entering new geographic regions, launching additional products, or targeting new customer segments. Market expansion is a key driver of growth, and understanding these plans can help you gauge the startup's long-term potential. Product development roadmap. Review the startup's product development roadmap. Are there plans to introduce new features, products, or services that could drive additional revenue? A clear and realistic roadmap shows that the startup is thinking ahead and has a strategy for continuous innovation. Customer acquisition and retention. Growth isn't just about acquiring new customers, it's also about keeping the ones you have. Evaluate the startup's customer acquisition strategy and its effectiveness in retaining those customers. High customer retention rates typically indicate strong product market fit and customer satisfaction, both of which are crucial for sustainable growth. Scalability. Determine whether the startup's business model is scalable. A scalable business model can grow revenues exponentially without a corresponding increase in costs. Startups that are built to scale can expand rapidly, which is essential for achieving significant growth. Key indicators of scalability include automation in processes, a large addressable market, and a product that can be easily replicated or distributed. Exit strategy IPO potential, an initial public offering, IPO, is one of the most lucrative exit strategies for investors. Assess whether the startup has the potential to go public. This typically requires significant revenue, profitability, and market presence. Startups with strong brand recognition and a unique market position are often good IPO candidates. Acquisition target: many startups are acquired by larger companies looking to expand their product offerings, enter new markets, or acquire talent. Evaluate whether the startup could be an attractive acquisition target. Look at the industry landscape and identify potential acquirers that might be interested in the startup's technology, customer base, or market position. Strategic partnerships: consider whether the startup has strategic partnerships that could lead to an acquisition or other forms of collaboration. Partnerships with larger companies can provide the startup with additional resources and market access, making them more attractive to potential buyers. Dividend payouts: some startups, particularly those in more traditional industries, may not pursue an exit strategy like an IPO or acquisition. Instead, they may provide returns to investors through dividend payouts as the company grows and becomes profitable. While this is less common in high-growth tech startups, it's worth considering if you're investing in other sectors. Time horizon: understand the likely time horizon for any exit strategy. Startups often take years to reach the point where they can be sold or go public. Ensure that your investment timeline aligns with the startup's expected exit timeline. Patience is key in startup investing, and knowing when you might see returns can help you manage your expectations and financial planning. Risk management: every startup investment carries risk, and a strong exit strategy is part of managing that risk. Consider the startup's contingency plans if their growth projections don't materialize. What's their backup plan? Understanding how the startup plans to manage risk and pivot if necessary is crucial for assessing the security of your investment. Assessing the startup's leadership and team: the strength of a startup's leadership and team is often one of the most significant factors in determining its success. Even the best ideas can falter without a capable and driven team to execute them. Therefore, when evaluating a startup, a close examination of the leadership and overall team dynamics is crucial. Founders and leadership experience and track record: start by looking at the founders and key leaders' backgrounds. Have they successfully built companies before? A track record of past successes, even if in different industries, can indicate a higher likelihood of success in the current venture. However, it's also important to consider how relevant their previous experience is to the startup's current market and challenges. Vision and passion: a clear and compelling vision is critical. The founders should be able to articulate not just what their startup does, but why it matters and how they plan to achieve their goals. Passion for the product or service often drives founders to persevere through challenges, which is particularly important in the volatile startup environment. Decision-making ability: strong leaders make decisive, informed decisions. Evaluate how the startup's leadership has navigated past challenges and their approach to problem solving. Have they demonstrated the ability to pivot when necessary, or do they stick to their original plan even when it's not working? The ability to adapt is a key trait in successful startup leaders. Network and influence: a founder's network can be a valuable asset. Connections to industry leaders, potential customers, investors, and advisors can provide the startup with opportunities that others might not have. Additionally, a well-connected leader is more likely to secure partnerships, funding, and other resources that can help the startup grow. Team dynamics: team composition: analyze the makeup of the startup's team. Are all the necessary skills and expertise covered? A balanced team with strengths in product development, marketing, finance, and operations is ideal. Gaps in key areas can lead to operational challenges and slow down growth. Cultural fit and cohesion. The team should have a strong cultural fit and work well together. Startups often face intense pressure, and a cohesive team is better equipped to handle the stress. High turnover rates can be a red flag, indicating potential issues with leadership or workplace culture. Talent and expertise. Beyond the founders, assess the skills and expertise of the broader team. Do they have the technical skills required to execute the startup's vision? Are there industry experts on the team who bring valuable insights? A team with deep knowledge in the startups sector is more likely to anticipate challenges and innovate effectively. Incentive structures. Look at how the team is incentivized. Are key team members invested in the startup's success through equity or performance-based bonuses? Proper incentives align the team's goals with those of the investors, ensuring that everyone is working towards the same outcome. Advisors and mentors. Advisor network. Consider the quality and relevance of the startup's advisors. Advisors who are industry veterans or have experience scaling companies can provide invaluable guidance. They can also open doors to strategic partnerships and new markets. Mentorship influence. Mentorship can play a crucial role in a startup's success. Mentors who are actively involved and provide actionable advice can help steer the startup through difficult times and complex decisions. Evaluate the extent of the mentorship relationship and how much influence these mentors have on the startup's strategy. Board composition. If the startup has a board of directors, assess its composition. A strong board with diverse expertise can guide the startup through strategic decisions and governance issues. However, a board that's too hands-on or misaligned with the founders can create friction, so balance is key. Leadership's response to challenges. Crisis management. Examine how the leadership has responded to past crises or significant challenges. This could include financial difficulties, market downturns, or internal conflicts. Their ability to navigate these issues with resilience and strategic thinking is a strong indicator of future success. Transparency and communication. Transparency in communication with the team and investors is essential. Leaders who are open about challenges and proactive in seeking solutions tend to build trust and foster a collaborative environment. This transparency is also crucial in maintaining investor confidence, especially during difficult times. If you're finding value in these insights, don't forget to hit the subscribe button and like the video. Stay tuned for more deep dives into what makes successful startup investments.